Everyone is talking about a shortfall in bank deposits. From the finance minister to the Reserve Bank governor, they're exhorting banks to accelerate deposit mobilization. Now, the FM's and the governor's warning has come because in the past 2 years, that is FY23 and FY24, bank loan growth has been more than deposit growth. In FY23, for instance, incremental deposits were 15.7 trillion, but incremental loans were higher at 17.8 trillion. Likewise, in FY24, incremental deposits were at 24.3 trillion, which is less than the incremental loan growth, which was 27.5 trillion. This, as SBI economist Soumya Kanti Ghosh reminds us, is a divergent growth rate which can't last for too long. In fact, Ghosh says, if you take deposits from even the previous year, FY22 onwards, FY22, 23, 24, then incremental deposits growth at 61 trillion is more than the loan growth of 59 trillion. Now, let us understand the relation between loans and deposits. Actually, every loan creates its own deposit. What I mean is that if a person A goes to a bank and asks for a loan, the bank doesn't take money from B's savings account and give it to A. It merely creates a deposit in A's name. Banks create money. Now, A may have taken the loan, say, to buy a house. So he writes a check to the builder. Okay, it's still in the bank. The builder then uses that money to buy cement. So he writes a check to the cement dealer. But you must note that the money has remained in the banking system, creating more deposits and loans. Then why are loans and deposits not growing at the same pace? Well, one reason is, for the most part, they do grow in a narrow band. The difference is not much. But deposits also leak. When we withdraw cash from the banks, the system's deposits are declining. Likewise, deposits also decline when we pay taxes. The government takes the tax money and accumulates it in its treasury. Until it spends the money via salaries or other payments, there is a drop in the bank deposits kitty. Money is also used by customers to buy foreign exchange, who then remit it abroad for purchases, for travel plans, or even to pay for their child's education. Now, Reserve Bank usually replaces this cash withdrawn by printing fresh money, which it introduces into the banking system by buying dollars or by buying bonds or even by giving the government a dividend. This money created by Reserve Bank is called reserve money. Now, to come back to our deposits discussion, one common expression we hear is that bank deposits are reducing because people are not saving via FDs. They are saving via mutual funds. Now, there's a bit of a confusion here. Even when a person buys mutual funds, the cash remains in the banking system as a deposit. It goes from the investor's bank account to the mutual fund's current account. The mutual fund may buy shares, and so the money goes to a broker who may buy or trade with some other broker and thus immediately pay another broker for another share. In short, saving via mutual funds doesn't reduce the total deposit kitty. It merely transfers the money to a current account and the money moves rapidly between banks. The habit of investment through capital market has hence reduced FDs or term deposits. Now, banks love term deposits. Why? Because they can give longer term loans. It's stable money for the bank. On short-term or mobile deposits like current and savings account, the Reserve Bank's LCR or liquidity coverage rule requires that 10 to 15% of these deposits should be kept in cash or near cash instruments like government bonds and T-bills. For a bank, this is slightly less lucrative because bonds carry lower yields. Loans are priced at higher interest. Bankers love term deposits or FDs because they're useful in giving longer term loans. Banks have ultimately to match the tenor of their deposits with that of their loans. This is called ALM or asset liability match. While digitalization is welcome for the country, bankers fret because savers are making frequent payments via UPI and this makes their deposits too mobile. Reserve Bank has asked banks to keep more liquid cover or LCR against unstable deposits. Now, why does the Reserve Bank have an LCR rule? The Reserve Bank's aim merely is that when a depositor comes knocking to withdraw cash, the banker can't say, sorry, I don't have liquid cash, I've given it away as a loan. The bank must have sufficient easily liquefiable instruments in case depositors come to withdraw. Finally, when and how does the divergence between loan growth and deposit growth narrow? The State Bank economist Soumyakanti Ghosh says these divergences usually narrow over a 2 to 4 year cycle. From FY20 to 22, incremental deposit growth was higher than incremental loan growth. From 22 to FY24, incremental loan growth was higher than deposit growth. Now, he thinks the two may become more or less equal by mid-2025, that is June 2025. For this, deposit rates will have to be increased by banks so that people put more money and deposit growth is fast. This higher cost will be passed on by the banks in the form of higher lending rates, which will slow down the loan growth. So the current war for deposits may be just a passing phase.